If you are an entrepreneur that needs to keep their business running for the next 5 years, or you are an aspiring entrepreneur who wants to start a business in the next 5 years, I gotta tell you something. The general consensus is that easy money is dead. There was actually one article that was titled, "Easy Money is Over and the VC World Needs to Adapt." It was very to the point, and I think it really summed up well what has been going on in the venture capital space. And I wanted to share these insights because it's not something that is being talked about super mainstream, and some of these things are things you only find out if you're already in that world, which doesn't help if you're trying to start a business and you have yet to break into it. So as I said before, the things we're going to talk about today apply to entrepreneurs that already have a business and want to keep it running and hopefully thriving in the next 5 years. And it also applies to aspiring entrepreneurs who are thinking of starting a business in the next few years as well. A couple of disclaimers: I am not an economist and I am not trying to sell you anything. These are just insights I wanted to share, including how we got there, some articles you can reference if you want to dive in further, and how investors and entrepreneurs are responding and what it means for the startup world. Okay, so getting right into it, how did we get here? The era of easy money, or is it era? Whatever. The era of easy money came to a close last week when the US Federal Reserve raised a key interest mark bench rate by 0.5%. And I say last week, it might be a couple weeks ago, depending on when you guys see this. And this announcement marked the end of historically low rates. Prior to this, investors needed options that were more attractive than safer asset classes like bonds. When interest rates are low, bonds don't do as well. So instead, investors turned to startups, and specifically, they turned to tech startups. And consequently, we saw a tech boom. All of a sudden, everyone was a technology company. Startups got a lot of funding, they made more products, those products made more money, investors were happy. The end, right? Well, no, or we wouldn't be here right now. So now the pendulum is swinging in the other direction. With interest rates up, venture capitalists are drawing back from their startup investments and putting their money into other safer investments like bonds, which are now more lucrative now that interest rates are higher. And the kicker here is that a lot of startups have only known this era of free-flowing money. We can call it a startup summer, if you will. But now, as TechCrunch has so eloquently put it, winter is not coming, it is here. So how are VCs or investors responding? During startup summer, investors made a lot of speculative bets on startups over the last 5 years. And now that the cost of debt is going up, they are worried about what their returns are going to look like in the next 5 years. They speak in increments of 5 years because when an investor puts money into a company and takes a piece of their equity or ownership, they are expecting that company to either IPO or get acquired within the next 5 years. And those are both events that allow them to get a return on their investment. Ideally, they're hoping for a 10x to 100x return, but that just isn't happening at the rate that it's used to. The rate that it's used to? Yeah, that's right. It's just not happening at the rate that it's used to, and the hit rate in general just keeps going down. So they're winning on fewer and fewer bets. From a VC perspective, they need to get smarter about where they invest their money. This means not investing in as many or any early stage startups, and then only investing in later stage, so like Series A and up, if they are profitable or on a path to profitability. In the last 5 years, investors have been able to just employ a kind of spray and pray strategy and make lots of bets and hope that one of them pays off in the billions of dollars to cover up all the losses. And that strategy is just not paying off. As my co-founder says, hope is not a strategy. And that is exactly what the VC world has been relying on for the last few years. It turns out that a lot of those bets were on overvalued companies, so companies that are saying they're worth more than they actually are, and companies that are, again, not on a path to profitability, but more on that later. One example of this that actually includes a really tangible resource is SoftBank. SoftBank is a massive firm that has invested in probably every startup that you know by name. Some of the companies include ByteDance, Cameo, Like to Know or Reward Style, SoRare, The Sandbox, FTX, Uber, WeWork, DoorDash, literally dozens or hundreds more companies. And they announced that they are cutting cutting back on their startup investments by 50 to 75%, which is massive. And they're doing this because they have lost billions of dollars on these tech investments. Their portfolio companies were already concerned that they were going to turn off the money hose, and now they know that that is in fact what has happened. And for a lot of these private companies that are still, developing and scaling, they are what is known as default dead. At a really high level, this just means that these companies cannot survive without venture capital funding to keep them going. They're not anywhere near profitability, so they rely on investor dollars to help get them there. YC actually sent an email out to all of their founders last week and mentioned this default dead versus default alive calculation. It wasn't too complicated. They basically just recommended that all of their startups get themselves to a point where their calculation comes out default alive as soon as possible. If you want to read up more on this and see if your company is default dead or default alive, I will leave a link to those resources in the description box down below. Okay, so now the important part, what does this mean for founders and entrepreneurs? If you're in the pre-seed to seed stage, I would not rely on being able to raise any venture capital for the next 5 years. This might mean doing things that don't scale to get your company off the ground and get over that profitability line. If you are a more mature startup, so like Series B and Series C, you absolutely must be on a path to profitability right now, yesterday, a week ago. That all being said, if you do decide to go after venture capital funding or debt financing, be prepared to address the following. I made a list. Insane valuations are out. During startup summer, a startup could take their annual recurring revenue or their ARR and a modest growth rate, say 5%, and give themselves a 100x valuation. For example, if you are making $10 million a year with a 4% growth rate, you could give yourself a $1 billion valuation, even though you don't have $1 billion in the bank or even in your pipeline. And investors would and did write you a check based on that $1 billion valuation. Not anymore. Now, with those exact same metrics, that same startup is getting a 10x valuation. So instead of being worth $1 billion, they are now worth $100 million, which hurts. That hurts bad because you haven't changed at all. The market has. The economy is just kind of punching you in the face. So knowing that several startups out there are raising additional funds to give themselves a longer runway that will hopefully last through that startup winter, even though they don't necessarily need those funds right now or even in the next year. They're just kind of stockpiling venture capital. Along with that, extravagant spending is also out. These all seem like very common sense things, but anyway. And if you aren't venture backed, like this was never a problem. You always had to watch where every penny was going. It's your money, so of course you're going to manage it with an eagle eye. For venture backed startups, VCs now want their money used very wisely on things that directly help the company scale, not outrageous marketing campaigns, parties, crazy salaries, splashy offices, and all the other ridiculous things that go on with startup life. And finally, as I've mentioned, I feel like 50 times during this video, you must be on a path to profitability, if not profitable already. And if that sounds strange and you're like, why do you keep bringing this up? Like, we get it, be profitable. It's because most venture-backed companies are not profitable for years and years. They use venture capital to gain market dominance, and then once they've pushed everyone out, they figure out how to make themselves profitable. But again, that takes years. So for example, WeWork, DraftKings, and Carvana are all not profitable. They are venture-backed companies worth billions of dollars, but they are not profitable at the time of filming this. To give you a sense of scale, Uber was founded in 2009, and they were not profitable until November of 2021. Similarly, Tesla, which was founded in 2003, was not profitable until 2020. And if you are an entrepreneur or aspiring entrepreneur, and for whatever reason you think that this message doesn't apply to you, bookmark this video and come back to it in a month. And just please make sure you don't drive your startup off a cliff. And if you want to learn more about startup funding and accelerators, get started with this video right here.